As I record this on February 28th, 2020, world stock markets are down, and they're down quite a bit. And predictably, that's making for some really juicy headlines and investor nervousness. But what about you? Are you worried? Are ya? I think it's worth mentioning that I might release this early, just so as to make sure that it's actually useful right in the middle of the current volatility. So if this comes out on a Monday or something, and you're a bit confused about why it's called 5 Minute Friday, just let it go. It's fine. Now, if you've watched this channel or listened to the podcast for any length of time, you will know, in your head at least, that volatility is part and parcel of how markets work. But still, if you're watching your investment values, you're seeing the drop-off, it can be uncomfortable, to say the least. You know, the head says it's fine, but your gut is freaking out. So today I want to give you some encouragement and just some reminders and some strategies to help you hold your nerve. So let's put 5 minutes on the clock here. Say a quick thank you to my friends at 7 Investment Management for continuing to sponsor the show, and let's crack on. Now, remember, you still own the same amount of stuff as you did before the decline. I'm going to try and studiously avoid the word crash in this video, if I can help it. So please remember, a loss is only a loss when you sell. What do I mean by that? Well, if you bought a house for, say, £250,000, you moved into it and lived there for 3 years. And then, just out of interest, you had it valued by an estate agent 3 years after you bought it. The agent sits down on your settee and they say, well, due to market conditions, the maximum that you could sell your house for was $230,000. 20 grand less than you bought it for. Ask yourself, would you have lost anything at that point? Now, the answer is no, because you haven't sold the property yet, obviously. And the same is true with stocks and shares. Just because they're worth less than they were doesn't mean that you've lost a bean yet. But the second you convert them back into cash by selling them, then you have indeed crystallized your loss. And that's why you never invest money that you're going to need in the near future, just in case a loss like this happens right before you need the money. Really important, a loss is only a loss when you sell. Second thing you need to know, selling when markets are down is completely counterintuitive. I had the privilege this week of listening to the inimitable Carl Richards speak. He goes online by the name of Behavior Gap. And he gave this brilliant quote, right? He said, stocks and shares are the only things that we rush to buy when they are marked up and rush to return when they are on sale. Think about that for a minute. I'll say it again. Stocks and shares are the only things that we rush to buy when they are marked up and rush to return when they are on sale. I mean, that's just madness, right? Imagine you're going to buy a car and you politely decline the discount that the salesperson is offering you, and instead you ask them when the prices are going to go up so that you can wait and buy the car then. It's just nuts. You would never do it. So why do that with shares and funds and pension and investment funds and stuff? It just makes no sense, and yet that is what the market movements that we're experiencing at the moment is making people think about doing. It's illogical. Third thing to remember is that investing should always be for the long term. There is a reason why advisors always say you should invest for the long term. It's simply because if you're investing for 10, 20, 40 years or even more, then you just don't need to worry about what's going on in the very short term. What do you care if your pension fund has dropped by 20%, but you can't even touch that money for 30 years or more? And if you look at any long-term chart of returns on stock markets, particularly on a total return basis, that's when dividends are factored back in, you will see that the long-term direction is always positive. Sometimes that takes longer than others, but the idea and the historical evidence for that is unequivocal. Number 4, there is little reason to worry about things that you can't control. Winston Churchill famously quoted an old man who apparently on his deathbed said that he had had a lot of trouble in his life, most of which had never happened, right? And that's definitely true of things like stock market corrections, coronaviruses, terrorist incidents, and lots more besides. We can't affect those things in any way, so why waste the mental energy in worrying about them at all? Doing so just adds more difficulty and angst to our lives when most of us have plenty of that stuff going on already. So remember, you don't lose anything till you sell, so don't sell. Selling when things are lower makes no sense at all. Investing should always be for the long term, so why worry about short-term fluctuations? And actually, worrying about stuff that you can't actually do anything about doesn't make any logical sense, right? You see, I've done it too. I've just used sound logic to make you feel a little bit guilty because you're worrying about the stock market. And that's bad. I'm really sorry, but I do it to make this last point. You need to recognize that you are a human and that millions of years of evolution have endowed you with a very finely tuned fight or flight mechanism. You're in a situation that you don't like. Markets are falling. Your first reaction is to work out what you can do to remove yourself from that situation. So you sell your shares so that they don't fall any further. You've achieved your sort of primordial aim. You're out of immediate danger. But stock markets are a highly developed mechanism and they don't reward amygdala level behavior. My friend Andy Hart put it best, I think, or maybe it was Nick Lincoln, not 100% sure. But either Andy or Nick, I think, said, stock markets reward the patient and they punish everyone else. Patience probably wasn't a virtue when faced with a saber-toothed tiger or a mammoth or a massive bear or something. But it is very much the right way to deal with investments. Please, please don't make any rash decisions around your money in these times of market volatility. This too shall pass. And if you can find the stomach to ride this out without doing anything which will hamstring your future success, your future self will be very grateful to you, believe me. Look, if you're worried, reach out to me via the Meaningful Money website. There's a contact form there. But do try not to worry. You can do this. You can ride it out. I believe in you. Okay? Do you believe in you? Hope so. Have a great weekend, and I'll see you next week.